Welcome to revision 14. This is on business risk and the merit and excellence questions related to this. The first thing you can see I've done is put liquid assets, current assets, liquid liabilities, current liabilities down here, which will help us answer questions. You can see also we've got trends for Ben's balance sheet. These are up and down. So if you can write those on yours, it will really help you when you do the exam paper. So here's a business that has negative trends. We can see that the liquid ratio has gone down from 0.83 to 1 to 0.30 to 1. That means for every dollar of liquid liabilities, Ben only has 30 cents to cover it with liquid assets. So they're in trouble. The biggest problem you can see here is that accrued expenses is 5,000. These are wages that need to be paid in the next couple of weeks, and they've got minus $4,000 in the bank. So he's going to be stressing out. The other issue, you can see the equity ratio is 0.34 to 1, which means for every dollar of assets, the owners financed 34 cents in 2022. That means that the banks are reluctant to loan any more money to Ben. Will put restrictions on him and borrowing more, and probably a higher interest rate. So there are issues here. Ben, though, has had a strategy, and his strategy is probably growing the business. So let's look at the problems. Where he's up and down, we'll look for the significant things. Obviously, bank, 2,000 to -4. That's a concern. Inventories increased. It might give a clue to some things that are happening. You can see that property, plant, equipment's gone up by 30,000, and that's been funded by an increase in loan of 30,000, not by the owner putting money in, and also capital's decreased. So what's happened? Firstly, if we just look at the capital decrease here is probably that the owner's taken more money out in drawings than they've made in profit. By taking more money out in drawings, this has both decreased capital, but also decreased the bank account. And so that's a problem that leads to an easy solution of reducing drawings. The second one that we have a look at is this increase in property, plant, and equipment. So Ben's been growing his business, funded by borrowing. So this has meant that the equity ratio will have decreased because there's an increase in liabilities, but no increase in capital to cover that. And thirdly, the problem we can see is the inventory has grown by 12,000, and that's been mainly by borrowing through or buying on credit. So you've got a 16,000 increase in accounts payable. So all of these are going to negatively impact on these ratios. So what's our solution? Our standard solution that we always write first is the owner invests $20,000. So if the owner's going to invest $20,000, we can see what's going to happen. Number one, their bank account is going to go from -4 up to 16,000. That will give enough to pay off those accounts accrued expenses. So that's perhaps a solution. So by the owner putting $20,000 in, that increases bank to $16,000. And also increases capital, which will increase the equity ratio. If that's not possible, because the owners don't like necessarily putting money in, the question I wanted to have a look at was this term deposit here. We've got 14,000 sitting in the term deposit, and yet they borrowed 30 here. Next solution would be to cash in the term deposit to put the money in the bank. So what would happen there is that bank would increase to $10,000. And it would decrease some of our liabilities, which is good that bank overdraft secured, but also have money in the bank in order to pay off the accrued expenses, increasing the liquid ratio and the current ratio. The third possibility here is return excess inventory or reduce inventory somehow, because it's pretty high here. So if we returned, let's say, $10,000 of inventory back to the supplier, that would reduce that to 26,000 and reduce this one here back to 15,000. And that would improve both the liquid ratio and the current ratio. Good. Time for the Kahoot.